Hey guys, in this recording we're going to be going over price action. Price action is essentially the behaviors of the market, the three behaviors of the market. Real simple, and this is basically going to be the basis of our setup. Okay, so let's first start up here. First topic, three behaviors of the market. The three behaviors of the market are the impulse, the correction, and our continuation. Okay, continuation, or you can consider this our new impulse. All right, so I'm about to break what each one of those mean down right now. The first one is the impulse. The impulse is going to be made up of long aggressive candles going in one direction. All right, and that can be either up or down. All right, and this is when the banks are moving the market. All right, this is when the banks are in the market and moving the market. And ultimately what the impulse tells you is which direction the market ultimately wants to go. Okay, so when you get these long aggressive candles going in one direction, the market is telling you it wants to go in this direction. All right, after that impulse has finished, what we're looking for is a pattern. Okay, and a pattern is made up of small consolidating candles. It's made up of small consolidating candles, and this is when the retail traders are in and moving the market. Like during the phases of consolidation, the retail traders are trying to push the market in a certain direction. All right, now what we ideally want to see for our setup is if the pattern goes in the opposite direction of the impulse, it is confirming the impulsive movement. All right, if the pattern goes in the opposite direction of the impulse, it is confirming the impulsive movement. So backing up, the impulse tells us which direction the market wants to go. And then once we get this pattern, if the pattern goes the opposite direction of the impulse, so our impulse is going up and our pattern ultimately altogether is going down, it is confirming that the market still wants to go up. All right, since this pattern is going down, it's confirming that the market still wants to go up. Now with this, we actually want to enter during this consolidation phase. We want to enter while we're within this pattern, and we want to enter ideally at the bottom of the pattern, which is right here in this area. Okay, this is the area where we want to look for our entry, because right after that, that's where our continuation comes, and we're looking to capitalize off of this move right here. All right, and the continuation, or you can just call it an impulse, right, because it's just our new impulse. That is our move playing out, and like I said, it is the new impulse. And since this is the new impulse, what are we expecting after that impulse? We're expecting another pattern to form. Okay, and if that pattern, and the pattern is going to have small candles that collectively going the opposite direction of the market, we want it to go in the opposite direction of the market for our setup. And if we get that, we look to enter again at this level here, and we look for that continuation. All right, so those are the three behaviors of the market. Breaking it back down: impulse, pattern, impulse, impulse, pattern, continuation. All right, now if we go ahead and look at this in the market, let's go down to the 4-hour. Remember the definition of our impulse: strong aggressive candles going in one direction. So we'll focus on this uptrend here. We have strong candles, strong aggressive candles going in one direction. After that, we have small candles going in the opposite direction of the impulse, and that led to our continuation. Okay, our continuation has long aggressive candles going in one direction. After that, we have small candles consolidating, right? Small consolidating candles. And again, this is when the retail traders are involved. And after that, that led to a new impulse, all right, where the big players came involved, when the banks came involved and moved the market. After that, again, we see that we have another impulse up, another pattern, and then price pushed up and gave us that continuation. Now that's for our long positions. That's for buying opportunities. Let's go ahead and take a few looks at selling opportunities as well. And then we'll go ahead and move on to the next section. So here, long aggressive candles moving down. This is when the banks are involved. The banks are moving the market here. After that movement, we got a pattern, and this is when the retail traders are involved in moving the market. And we ideally, again, want to enter right here in this area. And after that, we're looking for our continuation to play out, and we catch that move there. And that continuation is our new impulse. Again, we wait for a pattern to form. Once that pattern has formed, we're looking to enter when that pattern ends and looking to catch this continuation here. All right. So that's the basic breakdown of the three behaviors of the market. Now, one thing that you're gonna want to really implement or know when you're actually trading this, because this is the basis of our setup, you want to know when you should start looking for these sell opportunities and when you should be looking for your buy opportunities. Okay, now that goes in line with our full market analysis, understanding market structure, but to simplify it, we're going to focus on trend lines. Okay, when you're in a trend, how are you supposed to be paying attention to these? All right, when we have a perfect downtrend right here, and we can see right here, we have an impulse coming down. We have a pattern that formed here. So again, we have our impulsive move here. Strong aggressive move, strong aggressive candles moving in one direction. That's when banks are involved. Then we have our retail traders that came in, pushed the market up, and we found an opportunity right here to enter for our sell. And we continue looking for those opportunities as long as we're underneath this downtrend. All right, we keep looking for them as long as we're under this downtrend. Now, when we stop looking for our impulses and corrections to the downside, is when we get an impulsive move breaking the trend line. Okay, and here is a clear example of that actually happening. So here you can see price started to come back up, but it did not form small candles, did not form small consolidating candles here. Okay, there is no consolidation going on here. Price simply reversed and aggressively pushed past this trend line. All right, when this happens, you're not adjusting the trend line so you can still fit it under there, because then you just ignore the structure that respected that line here. Okay, once you have a solid trend line, do not move it. Allow it to sit there, and if it gets broken, adjust your analysis. You know you're not looking for sells anymore. So we got this impulse, strong aggressive moves moving in one direction. Then we got a consolidation period, which formed our pattern, and now we are looking for buys again. All right, just like that. Okay, and we keep on looking for buys as long as we're in this uptrend, and when that uptrend breaks aggressively with this impulse here, strong aggressive impulse down, we wait for that correction, and we start selling again, and we just go back and forth that entire time. That's how you capitalize off of this while implementing your trend lines, and how to trade it properly while if your trend line is broken. Okay, so that is essentially how price action works. If you guys have any questions, just go ahead and message me in the group chat. Also, the homework that I want you guys to do for this is actually find 20 setups on 5 different pairs. So you're gonna find this setup, an impulse and a correction, 20 times on 5 different pairs. All right, and break it up so like you're finding 10 bearish and 10 bullish on one pair. All right, that way you get a feel for how each of them form in different situations. All right, catch you guys in the next lesson.